Hello, PFXers, and welcome to the podcast for July 6th. So, an interesting end to last week. We had a round of US dollar weakness, which is, by the way, what we're looking at is the US dollar index. This is the value of the dollar versus a basket of other currencies. And it's actually a futures contract. As you can see here, we're just bouncing off of a support level. So, this is interesting. I have a fairly healthy amount of skepticism that this is going to last very long. We can take a look at the longer term trend we're fighting here, retracing here. But nonetheless, this has actually rocked the Forex pair, so we need to be prepared for it. And next week with the news, we have a couple of important items, but not a lot. So it's something that we're going to, we would anticipate that there's going to be some disruption in the market from a technical perspective as well as from a fundamental perspective. But we'll be looking at the technicals pretty heavily today. We actually start the week here on Monday the 7th in North America anyway, with a business confidence announcement from New Zealand. And I'm interested in the Kiwi dollar right now. It's a tricky one because it's real tempting to look for opportunities to trade the Kiwi dollar to the downside. The drawback with that, of course, is the interest premium. And so sometimes I look at one currency pair to find that may be unattractive because of one reason or another, and this would be a classic example, that interest rate payment, and try to transfer that information to another currency pair that maybe doesn't have the same kind of drawback. Now, one thing that we're experiencing here, so let's apply a retracement here. Business confidence, I'm not optimistic that we're going to get a really strong report. We're bumping up against a fib level here, just peeling off the 38.2% retracement zone. If we get rid of that, you can see where are we headed from a projection level. So if we apply this to, well, we can do it a couple of ways actually. Let's move forward a little bit in time. We're going to apply a projection level across this most recent consolidation from the bottom of the consolidation to the top. And that gives us an initial projection level of how far do we think the market's going to go. So we're thinking we're looking at around 73.10 or so. If the market continues to peel off, that looks like a pretty decent price target to me, which actually lines up real nice with that other fib retracement that I was drawing just a second ago over this recent rally that occurred in May. So where was that initial price target? That's heading down to here, almost exactly at that same level. So, which is because the markets tend to move in these waves, very often, you'll find these fib levels lining up. In fact, the Aussie, or the Kiwi rather, is an interesting one for that. This occurs over and over again. I'm going back to look at a pennant formation that everyone was watching very closely in April. If we draw our fib retracement here from the bottom of that pennant to the top of that pennant, so the very maximum price mark, you can see where the 161% retracement level got to right here with this pause in the trend in the middle of May. So we can, our chart now looks like a mess, but I think that you get the point. It's an interesting way, and I have found it to be quite reliable in creating price projections as to where do I expect the next consolidation to appear if the market is able to break through initial support. So we're looking at that right now to the downside. Now, this raises the question of, well, but what about that interest rate payment? Is there a way to get around that? Well, there is. We can use anticipating that the Kiwi is going to continue to be relatively weak in the pantheon of major currencies right now. We can mix and match it a little bit. Let me give you an example. So here I've taken the Kiwi and I've actually crossed it with the pound. So the pound Kiwi dollar. The pound has been outside, of course, the 3rd of July, has been much more stable against the dollar than a lot of other currencies. And so we can kind of mix and match these two and assume that if we go long the pound dollar, or the pound Kiwi, we're going to get an opportunity to break out to the upside. That's going to neutralize that interest payment considerably. Now, not completely. There's still an interest payment here, but depending on your dealer, is probably a lot less than what you'd be looking at with the Kiwi dollar, but then shorting the Kiwi dollar. So now, for those of you who work with dealers who don't have the pound Kiwi, because I know that there are some smaller dealers who, or dealers who specialize in a very limited selection of currency pairs out there, then you can obviously mix and match and make a synthetic currency pair with the pound dollar and the Kiwi dollar currency pairs themselves. But you'll have to balance that a little bit because the amount that you would be long the pound dollar is going to be inherently twice as much as what you in notional value as what you would be short the Kiwi dollar. So you'll want to watch out for that one. That we actually have some information on the PFX site that you can look up for trying to balance or create a synthetic currency cross that is perhaps not offered by your dealer, but that you would like to create and trade on your own. By its nature, such a trade is really something that you look for in the long term because your trading costs are more. You're entering two positions rather than a single position. Now, having said that, however, if it's really a matter of your analysis. If you feel strongly about a short Kiwi dollar position, then it could easily be worth the amount that you pay in interest. Maybe it's a pip and a half a day worth of value that you're giving up on that position. If the market is beginning to break out in a fast move, it could easily be worth it. So it's really something you have to weigh in your mind. How long are you planning to hold that position? The longer term, the more attractive a synthetic cross is, or this cross like the pound Kiwi pair is, versus for a shorter term position looking to take advantage of a breakout on the Kiwi dollar itself, it may be better to just trade the Kiwi alone. Now, for those of you who've been watching the podcast for a while, you know that we try to just limit the analysis to those announcements and such that we think are going to have the biggest impact on the market. Next week is a little light, but however, by Wednesday we do have labor coming out, employment coming out in Australia. This is going to be something that we'll want to watch pretty closely. The Aussie has been chasing gold here lately. There've been actually a couple of really great setups this last week where gold prices have taken off. The Aussie then lags and subsequently jumps up to take advantage of that, or to catch up with that, if you will. And that's a trade that I look for a lot. I've been talking about it for years. Doesn't always work out, obviously, but when it does, it's a pretty nice winner, and that's happened twice this last week. So that's one that I'm definitely going to be watching as trader sentiment is just coiled up here at this resistance level. Let's zoom in here a little bit. The market just does not want to go through the 96.50 range. A break above this level, that one thing that tells me is a break above that level would be significant. I would definitely be taking a long position at that point. We can start to make some projections about, well, where is that likely to go by looking at the most recent the depth of this consolidation zone that's been in place since the middle of May, and that puts us all the way up here at about 98.50. So a break of 96.50 sends us about 200 pips to the upside here to 98.50. Could be a very interesting trade. Going to have to wait for those labor numbers to come out. I'm not necessarily optimistic. Combined with the fact that we're against the resistance level, I would be moderately surprised if we saw a big breakout like that to the upside. However, the prevailing trend is so positive, it's really the only direction that I'm looking for trades right now is to the upside. So if the announcement comes out and it's fairly negative, probably just something that I'm staying out of in favor of trying to find trades in favor of the prevailing trends.